All right, so today we're diving into The Intelligent Investor
Oh, yeah.
by Benjamin Graham.
A classic.
A classic, yeah, and we're going to try to break down some of his key ideas about investing.
Sounds good.
So have you read this?
I have, yeah. It's dense.
Yeah.
It's a lot of information packed in there.
It can be tough to get through sometimes, but I think it's really valuable.
Absolutely.
So hopefully we can make it a little bit easier for people today.
Yeah, make it more accessible.
Yeah. So one of the things that Graham talks about that I always found really interesting is this idea of Mr. Market.
Yeah, Mr. Market. It's such a great analogy.
It is.
To explain how the stock market works.
Yeah, it's not a literal person, right?
Right.
It's this idea of this force, this entity that is always offering to buy or sell stocks from you.
Yeah, and the key is that Mr. Market is kind of emotional.
Right.
Right? He gets really excited sometimes.
Yeah.
And he gets really scared sometimes.
So how does that affect us as investors?
Well, the idea is that we shouldn't let Mr. Market's emotions dictate our own decisions.
So we shouldn't get caught up in the hype.
Right, exactly.
When the market is really high, we shouldn't just buy everything because it's going up.
And on the flip side, when the market's really low,
Yeah.
we shouldn't panic and sell everything.
That's hard though, right?
It is. Yeah, it's very human
Yeah.
to get swept up in the emotions of the market.
So how do we fight that urge?
Well, that's where Graham's idea of margin of safety comes in.
Okay, what's that?
So it's essentially buying assets for less than their true worth.
Yeah.
So you're building in this buffer
I see.
in case your assumptions are wrong.
So you're basically getting a deal.
Yeah, exactly.
And that protects you if things don't go perfectly.
Yeah, it gives you some cushion.
Like a safety net.
Yeah, like a safety net.
So how do we actually figure out what something is really worth?
That's where the work comes in.
Yeah.
Graham really stresses the importance of research and analysis.
So we have to actually understand the businesses.
Yes. You have to look at the fundamentals,
That we're investing in.
like earnings and assets and debts.
So we're not just buying a stock, we're buying a part of a company.
Exactly.
Okay, so that's the intelligent investor.
Right.
They're doing their research. They're thinking for themselves. They're not just following the crowd.
Yeah, they're not speculators.
Right.
They're not just gambling.
So what's the difference between an intelligent investor and a speculator?
I think the main difference is the time horizon.
Okay.
An intelligent investor is looking for long-term value.
So they're not trying to get rich quick.
Exactly.
They're playing the long game.
Right. And a speculator is more focused on short-term price movements.
So they're trying to time the market.
Yeah, they're trying to buy low and sell high.
And Graham says that's really difficult to do consistently.
It is incredibly difficult.
So it's better to just focus on finding good companies.
And holding them for the long term.
So I guess the big question is, how do we actually find those good companies?
Well, there are a lot of different factors to consider.
Okay, so tell me more about that.
Well, we can start by looking at Graham's recommendations for portfolio allocation.
Okay, so how should we be dividing our money between different types of investments?
Right, so Graham was a big believer in diversification.
Okay,
So don't put all your eggs in one basket.
spread the risk.
Exactly. And he recommended a mix of stocks and bonds.
Okay, so how much of each?
It depends on your individual circumstances.
Of course.
But he generally suggested a larger allocation to stocks for younger investors.
Because they have more time to recover from any losses.
Right, and a larger allocation to bonds for older investors.
Who are closer to retirement and need more stability.
Exactly.
So diversification is one way to manage risk. What are some other strategies that Graham recommends?
Well, another important concept is dividend income.
Oh, yeah, dividends.
Those lovely payments that companies make to their shareholders.
Right, but how do dividends actually contribute to long-term growth?
So you can think of dividends as like bonus apple seeds.
Apple seeds.
Yeah. Imagine you own a piece of an apple orchard.
Okay.
And every year you get a share of the apples it produces.
Okay.
Those apples are your dividends. You can either enjoy them now.
Eat them.
Exactly. Or, and this is where it gets exciting, you can plant those apple seeds to grow even more trees,
Oh.
generating even more apples in the future.
So you're reinvesting the dividends to buy more shares.
Yeah.
And that compounds your returns over time.
Exactly like a snowball effect.
Okay, I'm starting to see how all these pieces fit together.
Yeah, it's a system.
Stay calm despite Mr. Market's antics. Buy undervalued companies. Diversify your portfolio. Harness the power of dividends. What else does Graham have up his sleeve?
Well, there's another strategy he advocates for called dollar cost averaging.
Okay, I've heard that term before.
Yeah.
What is it exactly?
It's basically investing a set amount of money regularly,
Okay.
regardless of whether the market is up or down.
So you're not trying to time the market.
Exactly.
You're just buying consistently.
Right, like that artisan bread from your local bakery.
Okay. How does bread relate to investing?
Well, let's say the price of that bread fluctuates each week.
Okay.
Sometimes it's on sale, sometimes it's full price.
Yeah.
Would you only buy it when it's at its lowest point, or would you buy it regularly to enjoy it consistently?
I mean, I love that bread, so probably regularly.
Right.
So it's the same with investing.
Exactly. By consistently investing a set amount, you end up buying more shares when prices are low
I see.
and fewer shares when prices are high.
So it averages out over time.
Right. You don't have to worry about perfectly timing the market.
That makes sense.
So it takes the emotion out of it.
Yeah. That's appealing, especially for someone new to investing.
It can be less intimidating.
So it's like having a built-in system that takes away the stress.
Yeah, exactly.
I like that.
So yeah, that's dollar cost averaging.
So we've talked about margin of safety diversification, dividend income, dollar cost averaging, all these great strategies from the intelligent investor. But in your experience, how have these strategies actually shaped your own investment approach?
That's a good question.
And what about you listening in? Have you tried any of these techniques? Maybe you're already following Graham's advice without even realizing it.
Well, one of the biggest mistakes I made early on
Oh, tell me about it.
was trying to time the market.
Oh, yeah.
I thought I could outsmart everyone else.
Oh, yeah. We've all been there.
You know, buy low, sell high.
Catch those perfect moments.
Yeah. But it rarely works out that way.
No, it doesn't.
So that's where Graham's emphasis on ignoring the noise and focusing on the fundamentals was a real game changer for me.
Okay, so what does that mean exactly, to ignore the noise and focus on the fundamentals?
Well, instead of getting caught up in the daily ups and downs of the market,
Yeah.
I started focusing on the long-term performance of the companies I was invested in.
So you're looking at their track record, their earnings, their potential for growth.
Exactly, those core elements that indicate their true value.
Okay, so you're tuning out the market chatter and focusing on the signals that really matter.
Right.
Okay, I like that, and I think that's a good place to pause for now.
Sounds good.
We'll be back in just a moment to continue our deep dive into the intelligent investor.
Looking forward to it.
All right, see you soon.
Okay.
So we were talking about how easy it is to get caught up in the hype
Oh, yeah,
when the market gets a little crazy.
definitely.
And you were about to tell us about some of the mistakes you made early on in your investing journey.
Oh, yeah. I think one mistake a lot of us make is getting caught up in those hot stock tips.
Oh, yeah, the ones that are going to the moon.
Exactly. You know, you hear everyone talking about it and you think you're going to miss out.
Yeah, FOMO.
Yeah, exactly. Fear of missing out.
But then what happens?
Well, usually the hype dies down and the stock price comes crashing back to earth.
And you're left holding the bag.
Right. And that's where Graham's advice about being a contrarian really comes in handy.
Okay, so what does that mean to be a contrarian investor?
It means thinking for yourself and not just following the crowd.
So when everyone's buying, you should be selling.
Well, it's not always that simple.
Oh, okay.
But the idea is to look for opportunities where others are fearful.
So like buying stocks when they're out of favor?
Yeah, exactly.
Yeah.
That's where you can often find the best deals.
Because the price is lower than the intrinsic value.
Right, remember? Margin of safety.
Oh, yeah, that's right. We got to build in that cushion.
Exactly.
So it's like being a detective uncovering those hidden gems that everyone else has overlooked.
Exactly.
I like that.
And that's where Graham's idea of treating a stock as part ownership of a business really comes into play.
Right. We're not just buying a ticker symbol.
No, we're buying a piece of a company with real assets, earnings, and potential.
So we need to understand the business,
Absolutely.
not just the stock price.
All right, we need to do our research, look at the financials, and make sure the company is actually worth investing in.
So we're looking for value, not hype.
Exactly.
Okay, I'm starting to get it.
Good.
So we've talked about some of the mistakes that investors make, but what about the emotional side of investing?
Well, that's huge.
Yeah, I know. I've definitely made some impulsive decisions in the past,
We all have.
especially when the market is volatile.
Yeah, it's easy to get caught up in the fear and greed.
So how do we control our emotions?
Well, I think one key is to have a clear investment philosophy.
Okay, so like a set of rules to follow.
Yeah, exactly. It's like having a compass to guide you through the fog.
I like that. So what are some of the principles that should be part of our investment philosophy?
Well, I think Graham's principles are a great place to start.
Okay, so margin of safety, diversification, dollar cost averaging.
Exactly. Those are all important, but I think one of the most important principles is patience.
Oh, yeah. Patience is key.
It is building wealth takes time.
It's a marathon, not a sprint. So we need to be patient and disciplined and stick to our plan.
Exactly. And remember that the mark will fluctuate.
It always does.
There will be ups and downs. But if you stay focused on your long-term goals and stick to your principles,
You'll be more likely to succeed.
right.
Okay, that's encouraging to hear. Because sometimes it feels like investing is just a gamble.
I know what you mean.
Like you're just throwing darts at a board.
But it doesn't have to be that way.
So Graham is saying that we can actually control our destiny
To a certain extent, yes.
by making smart decisions.
And sticking to them.
Okay, I like that.
So what are some other things that Graham talks about that we haven't covered yet?
Well, one thing that really stood out to me is his discussion of market timing.
Oh, yeah, that's a big one.
So what's the deal with market timing?
Well, a lot of people think that they can predict the market.
Like when to buy and sell.
Yeah, and make a killing.
But Graham says that's a fool's errand,
He does.
even for the most experienced investors.
Right. It's incredibly difficult to consistently time the market.
Because there are so many factors that can affect stock prices.
Exactly. And many of them are unpredictable.
So it's like trying to predict the weather weeks in advance.
Yeah, good analogy.
So what's the alternative?
Well, Graham recommends focusing on finding undervalued companies
With strong fundamentals.
and buying them for the long term.
So we're back to patience and discipline.
It always comes back to that.
So instead of trying to time the market, we should just focus on building a solid portfolio
Jack.
and riding out the storms.
Right. And remember, diversification is your friend.
Spread the risk.
Exactly.
Okay. I think I'm starting to feel like a true intelligent investor.
That's great to hear.
But before we declare ourselves investing gurus,
Right.
I want to hear from you, our listeners.
Yeah, let's get some audience participation.
What are some investing mistakes you've made in the past? And how has Graham's advice helped you avoid them in the future?
What about you listening in?
Any investing confessions you'd like to share?
We've all been there.
So don't be shy.
Share your stories with us.
And we'll be right back after a quick break. All right, so before we let you go, we have one last thought to leave you with.
Okay.
Graham firmly believed that anyone could become an intelligent investor with the right mindset
Right.
and a commitment to learning.
Yeah, it's not just for Wall Street insiders or financial gurus.
It's for everyone.
Exactly.
He believed that with patience and discipline,
Right.
anyone could navigate the market successfully.
It's about democratizing investing knowledge.
Yeah, so it's not about being a genius or having some secret insider information.
Right.
It's about having the right approach
Exactly.
and sticking to it.
And being willing to learn and grow.
Now, I'm curious, do you think Graham's belief still holds true today?
Oh, that's a great question.
In a world of algorithmic trading and instant information
Right.
and ever-increasing market complexity.
It's definitely more complex than it was in Graham's time.
Right. So can the average person still become a successful investor by following his principles?
I think so.
You do.
Yeah. I mean, on the one hand, we have access to more information than ever before.
That's true.
With a few clicks, you can access financial statements.
Yeah.
Analyst reports all sorts of data.
It's amazing.
Right. So in that sense, Graham's philosophy is even more accessible today.
But there's a but.
But the sheer volume of information can be overwhelming.
Oh, yeah.
It's like drinking from a fire hose.
It's true. Sometimes it feels like there's just too much information coming at us from all directions.
And the market moves so fast these days.
It does.
So it's easy to get lost in the noise.
So how do we sift through all that noise?
Well, I think that's where Graham's emphasis on independent thinking becomes even more important.
Okay.
We have to be discerning about the information we consume.
Yeah.
We have to question assumptions
Right.
and develop our own filters for evaluating investment opportunities.
So we can't just blindly follow the latest trends or hot stock tips.
Right. We have to think for ourselves.
So the tools may have changed,
Yes.
but the core principles remain the same.
Exactly.
Do your homework, think for yourself. Stay focused on the long term.
Absolutely.
Build that solid foundation.
Yes.
And don't get swayed by the market's every whim.
Right.
All right, so I think that's a great takeaway for our listeners.
Yeah.
Investing is not about gambling or trying to get rich quick.
No, it's about building a solid foundation
Right.
for your financial future.
Based on sound principles and informed decisions.
Exactly.
It's about taking control of your finances.
Yes.
And making smart choices.
That will benefit you for years to come.
And on that note,
Yes.
we're going to wrap up this deep dive into the intelligent investor.
It's been a pleasure.
It has. We hope you found it insightful,
Yeah.
thought-provoking.
And maybe even a little bit inspiring.
Remember, the journey to becoming an intelligent investor starts with a single step.
Absolutely.
Whether it's picking up the book, researching a company, or simply starting to think differently about your finances.
Every step counts.
And who knows, maybe that step begins right here, right now with this deep dive.
I hope so.
Thank you for joining us.
It's been fun.
We'll be back with more fascinating deep dives, exploring new topics, and unpacking complex ideas just for you.
Until then, happy investing.
See you next time.